Hey everyone, this is John here with you. It's Thursday night, about 8:40 p.m. The Republican debate's coming on here on Fox Business in just about 20 minutes, so I'm looking forward to that. And before that, I want to do a quick update here. I know this will be the third one of the week. This one's going to be very short, maybe just 15 minutes or so. I just want to cover a couple things with you that I thought were very interesting here today, and so I thought I would share them with you. Let's go ahead and jump right into it. Please remember, this is all for practice trading, educational purposes only. The whole disclaimer, as a matter of fact, you should probably print out that disclaimer and keep it close by in case we forget to read it. You should just assume that we did cover it, but that's very important that we always do that. A couple things here. First, I want to look at this unbalanced condor position we have on, and I just have to go in here and hit edit spread and do it like that, so that the present day profit loss line will come up. Otherwise it won't. So just hit edit spread and hit OK, and then the line will pop up there, the dotted line. So just to review for those of you that are just joining us, a few days ago we got into this unbalanced condor where we bought a 1910 put, we sold an 1890 put, and then we did this on a 1:3 ratio where we sold 3 1800 puts and bought 3 1780s. So again, on the risk graph, right here, 0. Now, I know we've gone through this before, but for those of you that are brand new, I just want to cover it one more time quickly. This is the 0 line right here, and let me actually collapse that so we can see it. So this is the 0 line right here, the white dotted line across here, and where the purple line is, this solid purple line, this represents expiration day profit loss, the P&L for expiration day only. If the market finishes at this value or this value or that value or that value, what will the profit or loss be on the graph? So what's represented here on the expiration day profit loss is there's the 1910 put. That's the put we own. Right here's the 1890 put that we're short. So that steep slope that is the expiration graph for the expiration day, that is the what makes us profit there if the market falls down. Now, right now the market's at 1921, so it's above that. Right, it's well above that, but that's where the markets would fall through this area, the spread we own right here, the 1900 1890, and that spread would go up in value. Now, also, not only does that spread go up in value and give us some profit, well, profit for that spread, not necessarily profit on the entire trade, but profit for that particular 1910 1890 spread. But it also protects us very well from our short spreads down here. The 1800, 1780s, right? So we're 20 points wide on both the long spread and the three short spreads. So, you know, this is what the graph looks like. So, for example, if we expired right here at 1875.60, we would have 1995 in profit, and the reason for that is because the 20-point wide spread that is in the money on expiration, we would make the full 20 points minus the 5-cent debit that we put the whole trade on for, the entire trade on for. Okay, so that's 1995. That's what we're looking at there. And then down here is the same thing. If we finished at 1825, we would still have that 1995 profit, and you could see that in the right-hand corner. Now, if the market finishes anywhere above our long put, the put we own at 1910, if it finishes anywhere above here, we are going to lose $5 and only $5 per contract because we just have a 5-cent debit in it, and I can't get it right on the $5, but maybe if I really spread it out there and try to put it right on it, it will do it. Nope, it won't. That's about as close as we're going to get, 726 in the red. But it's only $5 in the hole for each contract. Now, if the market goes up, we're not going to let that happen. We'll do something to start bringing in some extra credit. We will sell out possibly this long spread we own, take some credit in, or more likely than that, we will roll these spreads up, these short spreads, the 1800 1780s that we are short. We'll roll those up just a little bit. But right now, what I want to show you here is a couple things. The delta is 0.02. So really what that is, that's positive 2.14. You have to move the decimal 2 times, right, like times 100. So the delta is really 2.14. That's basically flat. That's just saying that we would benefit slightly more if the market went up, if it went in a positive direction because the delta is positive. All right. So that's all that's showing us is the market needs to go up. But really, it's so flat. 2.14 is so close to zero that it might as well be considered zero. It might as well be considered flat. And you can see here on the expiration profit loss line, right now we're only $20 up on per contract. So if we had 10 contracts on this, a 10 by 30, we would be $200 up. But that would be a little more meaningful to us after 3 days being in this thing, whatever it's been. But basically we're up just a little bit on this thing, $20, which is nothing to get excited about at all. We could get out right now and cover our commissions, and that would be about it. But what I also want to show you here is the theta is 0.22, so that's $22 a day that this thing's burning for us. So basically, if we stayed right where we are at 1921.84, right where the market is right now, this trade is bleeding for us $22 per day. Now that doesn't sound like a lot, but on a one contract trade, that is quite good to be burning $22 per day. Anything above 10 is acceptable, just to give you a guideline, but we're burning $22 a day on this thing, so we are in very, very good shape as far as the theta goes. Now remember, if that theta is negative, we're paying the market to be here. Forget about being right or wrong. We're paying the market to be here to operate, and we don't want that. We want to keep that theta positive. And that positive theta comes from these short spreads here that we've sold, bleeding value at a faster rate, and we're short 3 times as many as the one we own, right? It's a 1-by-3 ratio. But these short spreads that we own are bleeding value at a more rapid rate than this spread that we own right here. Did I say that right? The spreads that we sold, the short spreads right here, are bleeding at a more rapid rate than the spread we own. This spread that we own is holding value a lot better because it's close to the money, right? It's close to the money. It's just 11 points above our the market's just 11 points above our long put. So this trade is looking really, really well right now. It doesn't have a lot of profit in it, but that's not the point I'm trying to make. It's just in really good shape. We shouldn't be losing any sleep over this. And if we can go from the 14th, which is today, and if we can just get through a few more days, let's say a week ahead of time, we go to the 21st till next Thursday, Friday or so, and you can see what the profit loss line looks like. If we trade up from here at all, we'll be in really good shape. We've got about $200 to $300 worth of profit depending on how far we trade up. And based on our downside risk, remember what our downside risk is. It's $4,000 minus the debit, so $4,005. And the reason is because we own 20 points right here, but we're short 3 times 20, which is 60 points here. So that's an overall risk of 40 points or $4,000. And take that $5 away, and that's what you have. That extra $5 debit, and that's our max risk. So basically, if we're sitting around the same area or even up a little bit, like at 1940.98, for example, I just let the mouse fall right there, we would have $325.99 in profit per contract. And if we divide that by that $4,005 risk, that's an 8% return. 8% return on this trade that we really did nothing on. No active duty on this on our part. Now, if we do start to fall off real rapidly, we might have a little bit of concern. But the good thing is we're only short 3 contracts here, so we can adjust those with a butterfly pretty easily, especially if it happens a little bit later in the cycle. That shouldn't be a problem, and we'll talk about that if and when that time comes. Now, the other thing I wanted to look at here, I told you this was going to be a short update, and it is going to be. The other thing I want to show you is something a little bit new, and I just like to try to keep you on your toes and keep you learning. But what I was looking at today is a standard broken wing butterfly, and it was actually for the regular March expiration, which is the 18th. That's March the 18th expiration. So let's go pull that one up. That one right there. So this was a little earlier when the market was down just a little. It was like at 1910 or so. But what I was looking at doing here to show you is buying a 1900 put, selling 2 1850 puts. And again, this is March expiration, March 18th, so it's basically 2 months out, about 63 days out, and then buying a 1780 put. right there. And I actually wrote down the mid prices at the time. Now right now this thing's going for a 45-cent debit. But, and not that that makes a difference. We could put this on as a practice trade as a 45-cent debit, but I'm going to use the field prices that I was looking at earlier. And I actually jotted those down here, if I can find them. Well, I know I did write them down. You just give me a minute to look. There they are. Okay, so this one was going for 61.40. These are going for 44.80. Now remember those 1950s there in the middle. We're selling 2 of those, so that's really 89.60 we're taking in, not 44.80. We're really taking in 89.60 because we're selling twice as many. And right here on the 1780s, those are going for 28.50, and that was a 30-cent debit on that. Okay, a 30-cent debit. So what I want to show you here is this thing. You know, if the market expires anywhere above our long put, which is at 1900, this thing only is going to lose $30, and you can see the $30 in red over here. So $30 per contract. Even if you put this on a 10 by 20 by 10, buying 10 contracts of the 1900s, selling 20 of the 1850s, and buying 10 of the 1880s, it's still just going to be a $300 upside potential loss. But again, we're not going to let that happen if the market goes up. We're not going to let that happen. So, but right now we're starting off with a 30-cent debit. That's no big deal. Or a little earlier, before I looked at it, or before I jotted it down, it was actually going for a little bit of a credit, like a 20-30-cent credit. But no big deal. As the market went up a little further, that credit disappeared and it turned into a debit. That's fine. But what I want to show you here is that on this butterfly, you can't really tell it now, but if we spread it out a little bit and look at it, this thing is a 50-point wide debit spread between 1900 and the shorts. There's the 2 shorts at 1850. So that would be the best case scenario, is if the market landed right at 1850 on expiration 60 days from now. That's not going to happen. Very, very unlikely. But I'm just showing you that the best case scenario. So if the market finished up here at 1850, our 50-point wide spread would be completely in the money. This 50-point wide spread here between 1900 and 1850, that one I'm tracing there, that thing would be in the money, and we would make 50 points on that, minus the little 30-cent debit, so we would make 49.70 is what we would make on that. Right there, there you go, perfect. I'm holding it, 49.70 right there. That's what we would make, and the credit side would finish out of the money. But what I want you to see here is this is a 50-point wide spread that we own, and a 70-point wide credit spread that we're short. And again, it's a 1900, 1850, 1780. So we own 50 points. We're long 50 points, but we're short 70 points. So this thing only is carrying how much risk? Only 20 points of risk. And if you look down here on the bottom side of this, below our tail, our butterfly tail is at 1780. If you look below that, if the market finishes anywhere below that, we're going to lose $2,030. Why 2030? Because we'll take the max 20-point risk. We'll make 50 on the debit side, but lose 70 on the credit side. That's 20 points. That's $2,000 real money, plus the $30 debit. Now, something that's really cool about this thing, if you look at this, this butterfly is really resilient. It's a really resilient trade, because even if the market falls all the way down to like 1850, look at that. We're only down like $230. You see that? That's very manageable, very, very manageable. Now, this is a little bit of a longer-term trade, but it gives us plenty of time and opportunity to play with it. So if you watch the dotted line, if we move forward here, well, watch that dotted line. Watch this area up here above the trade. Even though the market's not anywhere near the trade, look up here above the trade. Even if we go to February the 3rd, and let's say the market's at 1950, we'll be up about $250 or so, roughly $240, right there. Okay, we'll call it 240. And if we make $240 on this thing, and we divide that by the $2,030 risk, that's 12%. That's 12% that we've made between, like in the next 2 weeks or so, on this trade, if the market just goes on up, which it's likely to do at this point. It's been down so hard, and it bounced big today, so we're likely to see some more bouncing. But even if it doesn't, if the market goes on down, you can see we don't fall off a cliff here, right? We just kind of slope down, and that makes the trade a lot, I don't want to use the word easy, but it makes it a lot more manageable to deal with on the downside. Now, what's the simplest way to neuter this thing, to get all the risk out of it? Well, we have how much at risk? We only have 20 points of risk. So if we came in here and we bought, if we bought a an 1800 1780 put spread, and we'll do that at the mid price just to see what it's going for right now. An 1800 1780 put spread. Watch what it does to the downside risk of this butterfly when we put this on. And all we're doing is we're rolling the 1780 up 20 points to 1800. It balances it out. You see that? It balances that butterfly out. Now we do have some loss on the upside of the butterfly. We have some risk on the upside, and we have some risk on the downside. But overall, watch the line there. If the market's trading anywhere near the butterfly itself, we'll be in good shape. But here's the thing: if the market actually goes down that far that we need to take the risk out of the downside, or greatly reduce the risk in the downside, we're going to do something else with this long spread here to help pay for that. All right, so that, I just want to point that out. But this is a really nice trade. It's up $15 so far from the debit it was going for when I wrote it down, and that makes sense because remember when we just put it on a few minutes ago and I just used the mid prices, it was going for 45 cents. So if we put it on for 30 cents earlier and now it's going for 45, that's $15 per contract. So it's only that's how much it's up right now, $15. So it's better than being down $15. But what you can see here is we just let a little bit of time pass. And unfortunately, that 1780 is not showing us the Greeks here for some reason, so we can't look at our theta. But obviously, if we let some time pass, it's holding up. There's really no upside risk in this thing. Really no upside risk, and the downside's very manageable. So it's a 50 by 70 on the spreads. We own 50, short 70. But I like this trade real well. So we'll put this on as a practice trade and follow it through. I'll catch up with you guys next week sometime, maybe Sunday night, Monday night. We'll see what happens. And I hope you all are enjoying this. Don't forget that there's a lot of you that are using the Market Insights right now as a trial back from like some previous online classes, and so you're using this from the oh man, I'm going blank. I can't even think of the name of it that I taught a while back. It had a name like the split decision, that thing. But anyway, you're getting the Market Insights as a trial right now, folks. If you like what you learn here in the past month or so, if you've really enjoyed this and think you could benefit of doing a lot more of this, sign up for the Market Insights. Stay in here for a couple of quarters and fill it out a little bit more and see how you like it. And I do my best to really try to make this worth everybody's time and effort to learn this stuff. So it's really some great stuff. So we'll carry on with it and keep working hard and just staying at it. But in the meantime, if you are about to expire from that month trial you had, be sure you sign up right away and don't let that lapse, because we're going to be covering some amazing stuff in here in the future, as we always have been. So I look forward to continue working with you all. But everyone have a great night and a good weekend. I will see you all around the first of next week. We'll see you then. Bye-bye.